Okay, I don't think we can get away with having a channel that's called Market Movers without covering the market that's been moving the most over the past week and that everyone is talking about. I know it's been talked to death by now on every possible YouTube channel that wants some clout and everywhere else on the news and so on, but I think we need to talk about GameStop. So I've had comments asking for my views on it and, to cover the topic. And so let's go into it. What we'll do, I'll give you a bit of a background about what's happened for those of you that aren't aware of it. If you don't go on social media, you don't watch the news and you don't follow that particular market. And then I'll give you my opinion on what's been happening and, what I think of it. So for many people, GameStop has been a fundamentally flawed company for a long time, a company that's been on the decline. And so that's why it was such a surprise for a lot of people when the stock price started to creep up last year. Now, a rising stock price on an allegedly, I'm going to say allegedly because it's, an area of disagreement amongst many investors, but it's an allegedly flawed company. So if the stock price is going up with the company that people see as being flawed, of course it's going to attract short sellers. Now, unfortunately for those short sellers, to kickstart the new year, GameStop appointed 3 new directors to the board, and the news soon attracted retail traders, amongst other things. However, these weren't just any old retail traders, it was actually catching the attention of WallStreetBets. Now, for anyone that doesn't know, WallStreetBets is basically an online community. It's a subreddit on the website Reddit. Now, anyone can join, but unlike other typical investment forums, and we use the term investment forums very loosely with this one, this subreddit, this community, is all about the memes and the lols and the banter. So for WallStreetBets, due diligence is more of an optional thing. In fact, DD means something entirely different. And the legends in that subreddit aren't just made because of epic wins they've had, but also epic losses as well. Even before all of this stuff recently with GameStop, they were notorious for a few different things, but amongst those was the popular investment strategy used in the subreddit, which is to YOLO your life savings. Basically to bet your life savings on a highly leveraged option trade or something like that, so you've got high reward but extremely high risk. Now, over the past couple of years, thanks to things like commission-free trading, platforms like Robinhood, the growth in popularity of online trading forums and trading on social media, along with the boom in cryptocurrencies and the pandemic itself, it's basically led to the number of retail traders increasing rapidly, and the clout of WallStreetBets has boomed along with it. So WallStreetBets has grown into one of the biggest online communities. I find it absolutely crazy because I remember a few years ago when it was relatively obscure compared to how it is now. And you'd kind of go on there and have a laugh and people were not taking it too seriously. You'd have some people who are doing fantastic work, like great trade ideas or great thinking behind it, obviously knew what they're doing, good due diligence, but then would apply all of that to extremely high risk positions because it was kind of like, ironic to put in all of that good research and then YOLO it all away. But basically it's just boomed, absolutely boomed. Last week alone they ended up with almost 7 million followers, up from 2 million at the start of the week. That's massive growth. And I can remember that when they had their last sort of event that attracts all the headlines, I think it was when they found the loophole in Robinhood for free money. I think they hit 1 million for the first time then. Now they're looking at 7 million. That is insane. Now, many people just come for the memes and to have a laugh. But if you're a new member and you don't know what WallStreetBets is, you don't know, what they stand for, what they've done in the past, I would say don't take what's written on that subreddit too seriously. Of course, what's been going on is very serious, like with GameStop and so on, but that subreddit shouldn't be taken seriously. But with that in mind, betting on a company that was regarded by many as being fundamentally flawed and on its way to bankruptcy is just so typically WallStreetBets that it comes as no real surprise. However, those retail traders had obviously seen something that few others had. GameStop had become one of the most shorted companies out there, with short interest at over 140% of the float. At 140%, it means that all those short sellers wouldn't be able to cover the trade if needed, since the way out of a short is obviously to buy the shares back. So this created the perfect opportunity for a short squeeze, one that a few particular hedge funds definitely didn't see coming. So last week, the stock price closed up almost 400%, and for the whole month, it was up over 1,600%, with a lot of volatility and swings in between. I think at its peak, it was up over 2,400% or something. absolutely crazy. So it seems that no longer are the markets just dominated by the institutions. GameStop just goes to show how the promise of free tendies can drive retail traders to a market and have a huge impact on the price. A risk that maybe a few particular institutions underestimated and should have paid a bit more attention to. So what actually happened with GameStop? Well, what we're seeing, as I mentioned before, is basically a short squeeze. But in this case, it's like a matchup between institutional investors and retail traders. Or at least that's what it's being billed as, but we'll come on to that in just a moment. So as retail traders are buying the stock through either stock purchases or options trades, it's pushing up the price of the asset. So then short sellers are forced to cover their position by buying the stock, which then adds even more fuel to the fire and pushes the price up even further. So since the stock was already heavily shorted, this means there's a lot of sellers who need to cover their position. And when that happens, it's very bullish for the stock. However, there is also another twist in the GameStop saga, because some hedge funds have made it personal, which has added to the drama and pulled in even more retail traders, which has then backfired for these institutions in rather spectacular fashion. One of these was Melvin Capital, which disclosed a big short bet on GameStop, which then led to WallStreetBets targeting them with the intention of collapsing the fund. And based on a recent announcement, it appears it's probably worked. Because last week, I think it was announced that the fund was down over 50% of the $12.5 billion that it manages. Citadel, along with Point72, also injected $2.75 billion into the fund, essentially giving it a bailout. So to put it bluntly, institutions perhaps underestimated the risk posed from retail traders, and maybe they shouldn't have. But on the opposite side as well, retail traders obviously need to be very careful and consider the risks, because YOLOing away your life savings into a stock based on a meme or a trend isn't exactly the most prudent way of investing or trading. But I think for many of the traders on WallStreetBets, this went from simply being a short squeeze that they were trading to becoming more of a personal FU to the suits. This is something that we saw building up during the pandemic with people like Dave Portnoy and other people citing the 2008 financial crisis and this being some sort of payback. So this anger that people have for the wealthy and for financial institutions who don't seem to have to suffer the consequences for their actions in many cases, all of that anger may be coming out in this particular trade. But in reality, only a few funds are really taking the real heat on this trade, since there will also be plenty of funds rising this trade up and down alongside the retail traders as well. So this is where I bring my views into it. So what do I think about the GameStop situation? Well, in terms of delivering a message, I think that message has been heard loud and clear that institutions cannot just dominate these markets. However, the reality of the situation I think is a little bit different, because actually there are some hedge funds being targeted and there'll be some institutional investors that are suffering on one side of the trade. But who do you think is probably benefiting the most on the other side of the trade? I don't think that these prices are being driven just solely by retail traders. There'll also be family offices, institutional investors, and who knows who else. But they will be benefiting just as much, if not more. So at the same time as targeting institutional investors and saying they must suffer, there will actually be many more than those benefiting. So actually the balance is more in their favor than against as a whole. But the message is what's important, I think. And do you know what? There's something almost Marxist about it, about the common everyday person rising up against these authoritarian figures. So maybe it's something that Marx would be proud of, although there's obviously a capitalist undertone, so maybe not. Now, in terms of the retail traders and investors who are buying up this stock, what do I think about that? Well, whatever way you look at it, this is basically a bubble that's developed now. So whatever the rationale behind buying up the stock in the first place, whatever's caused it to sort of exponentially rise like this, it doesn't matter. At the end of the day, it's still a bubble where the stock price does not reflect the value or any change in the company, like the underlying asset there. So it's being driven up by this sort of like mad rush to get involved and this excitement from everyone. So there's a bubble there. Now, we saw the same thing with the cryptocurrency boom. Before that, there's been obviously the dot-com bubble and various other bubbles throughout history. And what always happens to a bubble is that eventually it bursts. And it's one of the most common things I hear these days, where people will say, I lost most of my life savings on the cryptocurrency crash Obviously, it's been rising a lot more again recently, different cryptocurrencies, but they lost a lot of their life savings, if not all of it, because they jumped in at a friend's recommendation or because on social media there was this mad rush to buy up cryptocurrencies. And now they've started learning to trade and invest properly because they wanted to make their money back. And I think with GameStop, there's a lot of people that are just jumping in now just because they're seeing everyone else jumping in. Maybe a bit of FOMO, maybe a bit of excitement, wanting to be part of something, wanted to stick your middle finger up at the man or whatever it might be. So there will always be the bag holders. There will always be the greatest fall, right? Based on the greater fall theory that buys at the last point before it drops. We got a taste of it last week when Robinhood and various others ceased buying for a little bit of time and you could only sell the stock, and you saw what happened to the price then. At some point, the price is going to collapse. So based on that, I think that there's no harm in holding on to the stock for a while, but sell some so that you've banked some profit. I know that everyone will be saying, no, have diamond hands, don't sell, don't sell, stay in the stock, like let's keep it rising. But be smart about it. If you're jumping in with your life savings, make sure that you take some profit. It's the same as any trade, any investment. You scale out after a certain point when the uncertainties and the risks are higher than what's acceptable for you at that time. Now, the other thing is about the legality of it. Whether this is all legal or not, I would veer onto the side of saying that it's actually illegal, it's market manipulation. However, with so many individuals, I don't think anyone's really going to get prosecuted, but that doesn't necessarily mean that regulators might not step in the meantime and sort of stop things or demand that things are done to sort of halt this volatility. At the end of the day, there's always this sort of responsibility to avoid bubbles, dangerous bubbles that cause sort of ordinary investors to be completely out of pocket. Now, you could argue and say that's what hedge funds cause and institutions cause it, and it's just the other way around now. But actually, I think the ones that will be most damaged in the end will be retail traders and investors. Just like last week when we saw the price plummet when Robinhood stopped you being able to buy, the people who were complaining that they lost their entire life savings were not hedge funds, it was the retail investors. Now, there was an interesting interview, I think it was on Sky News, with the real Wolf of Wall Street. In fact, we'll play the clip, Jordan Belfort, and he was basically saying that what's being done here is essentially what he did in his company that he ended up going to prison for. And the same thing's happening. It's basically pumping up a stock. It's going to be a pump and dump because at some point people are going to start selling, and that's when the price will start dropping a lot.
It's illegal what they're doing. Theoretically, you can't collude together to buy stock. Right. So that's really, and that's, by the way, when I said it was like a bit like Stratton, my firm, that's what I was alluding to, that it's so much like what we were doing, except instead of having one firm doing it, it's all these individuals almost acting like a firm together.
But, you know, overall, I think that it's an exciting thing. I've not seen anything like this. There have been plenty of things over the past 10, 20 years that have been absolutely insane in the financial markets. And this is right up there. And so I think that it's good to be part of that. It's quite interesting and exciting, but people need to be careful and realize that in the financial markets, in economics, whatever, there's no such thing as a free lunch, and some people are going to have to pay. And I think you'd be naive to think that the ones that are going to pay for this are going to be the institutions. And especially in a market like silver, I mean, we only have to look back at history. I think in the 70s, it was the Hunt brothers, Bunker Hunt and his brother, one of the richest men in the world, a billionaire, tried to corner the silver market. It went disastrously wrong and he went bankrupt. So let that be a warning. If it can happen to a rich person in the world, one of the richest people in the world, it can happen to the everyday investor as well. But overall, if GameStop is going to the moon, then by all means hold on. But please do play safe and, you know, bank some profit to make sure that if things do go tits up, you're not kicking yourself in 10 years thinking about what could have been. But make sure you make wise decisions along the way with this one. Now, let me know in the comment section what your thoughts and opinions are. This is one that I think everyone's got an opinion on at the moment. And if you like this video, please do hit the thumbs up button. If you're new to the channel, do subscribe. We cover the financial news, fundamental analysis, and our opinions on all of that stuff. So hit the subscribe button and I'll see you in the next one. Take care, guys.